Hey everyone, welcome back to Corporate Decoder, the place where we unpack the secrets buried deep inside corporate filings. And today we're looking at a very interesting report from Celanese Corporation, a company known for its chemicals and specialty materials. Get ready because this filing is going to reveal some interesting moves they've been making in their debt structure. Before we jump in, if you love getting clear, no fluff insights from these often complicated documents, a quick subscribe button. Click is super appreciated. And if you want to connect with other finance enthusiasts and get early access to our analyses, jump on our Discord server linked in the description below. So what is the big story here? Celanese Corporation, essentially through a subsidiary, has just completed a major offering of new debt, specifically senior notes, which are basically fancy IS they sell to investors to raise money. They've issued two main types of these notes, one set due in 2031 and another set due in 2034, totaling a whopping $1.4 billion. This isn't just about them borrowing more money. This is a strategic move to refinance existing debt and also to fund some significant buybacks of their older, higher interest debt. This whole debt deal was put together using a core agreement called an indenture, which is like the rulebook for these notes. They've essentially updated this rulebook with a new agreement, the 17th supplemental indenture, to cover these new notes. Think of it like adding an amendment to a contract to include new terms for a new loan. So what are they doing with all this borrowed money? A big chunk of it, like $1.2 billion, is going towards buying back their older debt that carries higher interest rates. This is a smart move because it means they'll be saving money on interest payments over time. They're also using some of the funds to pay off a term loan that was due in 2027, and whatever is left over will be used for general company purposes, which can include paying off other debts. This is all about optimizing their debt structure, making it more manageable and cost effective. Now, let's quickly look at what else is on their books. The company has several types of publicly traded debt, including these senior notes due in 2026, which had a 4.7777% interest rate. They also have notes due in 2027 at 2.125%, 2028 at 0.625%, 2029 at 5.337%, and even notes due in 2031 at 5.00%. These are all listed on the New York Stock Exchange under their respective ticker symbols. The new debt they've just issued, the 2031 notes at 7.000% and the 2034 notes at 7.375%, are higher interest rates than some of their existing debt. This is a clear indicator that they are prioritizing getting rid of older, more expensive debt, and also possibly reflecting current market conditions for borrowing. So the actual legal documents outlining the terms of these new notes in the indenture are filed as exhibits. Exhibit 4.2 is the 17th supplemental indenture. This is where all the fine print about the guarantees from Celanese Corporation and its subsidiaries, how interest is paid, and other important details are laid out. It is essentially the contract for this large borrowing. When a company does something like this, especially involving significant debt, they usually get legal opinions from outside lawyers. Gibson, Dunn and Crutcher LLP provided their opinion on this the 17th of November, 2025. This opinion basically confirms that the securities being issued are legally sound and all the proper procedures have been followed. It is a standard part of these types of financial transactions, offering assurance to investors. Now, let's talk about what this all means. Celanese is actively managing its debt by issuing new notes and using the proceeds to retire older, more expensive debt. They are essentially trying to lower their overall interest expenses and potentially improve their credit profile in the long run. The fact that the new notes carry higher interest rates suggests they might be doing this because the market conditions have changed, or they might have a specific strategic reason for optimizing their debt maturity schedule. This kind of debt management is pretty common for large corporations, and it shows they're trying to be proactive about their financial health. The key takeaway here isn't just that they borrowed money, it is that they're actively reshaping their financial obligations, a move that could lead to significant interest savings down the line, if interest rates fall or if they can continue to refinance at lower costs in the future. Looking at the whole picture, Celanese seems to be in a phase of actively managing its financial structure. They're not just letting existing debt sit around, they're strategically replacing it with what they believe are better terms for them. This can be a sign of strength, indicating confidence in their ability to service this new debt and potentially benefit from lower future interest costs. However, the higher interest rates on the new debt are something to keep an eye on. It highlights the current cost environment for borrowing and suggests that past favorable interest rate conditions might not be as readily available now. The strategy itself is sound, but the devil is always in the details of execution and the prevailing economic climate. It's a calculated move to potentially boost future profitability through reduced financing costs. Alright, That is our breakdown of Celanese Corporation's latest filing. What is your take on these debt management strategies and what they signal for the company's future performance? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps. And subscribe for more deep dives into corporate financial moves. Don't forget to check out the Discord in the description below for more discussions. Thanks for watching. See you next time.